everyone. Welcome to Sam's Summaries. This episode is a deep dive discussion into Sam Fury's summary of Chapter 7 from the book How to Swing Trade by Brian Pazim. It has been created with the help of AI. The chapter is titled Technical Analysis Charting Basics. You can read the original post at samfury.com.
All right, let's get ready to level up that trading game, okay? Today, we're going deep into swing trading with candlestick charts.
Swing trading, yeah, it's all about those shorter time frames.
Yeah.
Buying and selling assets, trying to ride those price fluctuations, right?
It's kind of like catching those waves, surfing those price waves. But the thing is, understanding those charts...
Especially those candlestick charts.
Yeah. Sometimes they feel like some kind of secret code, don't they?
You do.
But no worries. Today, we are cracking the code together.
That's right.
With Chapter 7 of Brian Pazim's book, How to Swing Trade. This is going to be our guide today.
Awesome. And I think what's really cool about candlestick charts is, they're not just some random lines on a graph.
No.
They're actually like a visual representation of, what's going on in the minds of all the traders.
The psychology.
The psychology, exactly. Of the buyers and the sellers battling it out.
Oh. Okay, you've got me intrigued already. So how do we start decoding this trader psychology, this visual language? What's the big idea?
So technical analysis, which candlestick patterns are a part of, right?
Yeah.
It's based on the idea that what happened in the past with price movements can give us clues about what might happen in the future.
Oh, interesting.
So it's all about identifying patterns and trends, things that suggest, okay, where might the price be headed? What's going to happen next?
So it's almost like looking for those footprints in the sand.
Right.
To see which way the crowds are moving.
Exactly. It's like, imagine you're at a marketplace, right? Really bustling marketplace.
Yeah.
You got buyers, they're trying to get the best deals. And then you have sellers, they want the highest price.
Right.
And then you got this other group just watching, waiting for the right moment to jump in.
Yeah.
Right. So that's kind of what's happening on the stock market, just on a much, much bigger scale.
I can see that. It's like this constant push and pull between all these different forces. The
Right.
buyers, the sellers, and then those just waiting.
Yeah. And, those forces, they are reflected in the prices we see on these charts. So each candlestick on a chart represents a specific time frame.
Okay.
It could be a minute, an hour, a day, however you set it.
So each candlestick, it's like this little snapshot of what happened during that specific period.
Precisely. And within that candlestick, within that little snapshot, we're capturing 4 key pieces of information.
Okay. What are those?
So you have the opening price, the closing price,
Okay.
the highest price the asset reached, and the lowest price it dipped to.
Oh, wow. So much information in just this one little candlestick.
Right.
So walk me through, what does it actually look like on the chart? What is the anatomy of a candlestick?
Okay, so picture this. You have the body of the candlestick. This is the wider part.
Yeah.
And it's showing us the range between those opening and closing prices.
Okay, I'm with you. The body, wider part, opening and closing. Okay, so what else?
And then you have these thin lines that extend above and below the body. And those are called the wicks, or the shadows.
Yeah.
So the wicks are kind of like showing us those extremes. How far the price strayed from that opening and closing during that time frame.
Exactly.
Okay, so we have the body, we have the wicks. What about the color? I've seen those green and red candlesticks. What do those mean?
Right, so the color, that tells you at a glance whether the price moved up or down during that specific time frame.
Okay.
So generally, if you see a green candlestick, that means that the closing price was higher than the opening price.
So it's a good thing?
We call that bullish. It suggests that the buyers are in control. They're pushing it up. And then on the flip side, a red candlestick means that closing price was lower than the opening price.
Oh, okay.
So that's bearish, indicating that the sellers, they kind of have the upper hand in that particular time frame.
So green, generally good. Red, signals caution, be careful.
Right.
Okay, that makes sense.
Yeah.
Now, you mentioned buyers and sellers battling it out. How do we actually see that reflected in these candlesticks?
Yeah.
How do we know who's winning this tug of war? Yeah, so that's where the size and the shape of those candlesticks start to come into play. For example, if you see a long green candlestick, but it has a really short wick at the top.
Okay.
What that tells us is that the buyers were really strong during that time.
Oh, interesting.
They pushed that price up significantly, and they were able to hold on to those gains.
So the longer the body And the shorter the wicks, the stronger the conviction of either the buyers or the sellers.
Exactly.
Depending on the color. Okay, so it's not just about the price movement itself, but the sentiment behind it,
Yeah.
right? Like how strongly those buyers or sellers are feeling.
Right. It's like if you see that long green candlestick,
Yeah.
think about it. That means that a lot of people were willing to buy that asset at higher and higher prices.
Wow.
They were confident. They thought it was going to continue to go up.
So there was a lot of conviction there.
Exactly.
Yeah.
Now, before we jump into specific candlestick patterns, I think it's important to talk about these support and resistance levels,
Oh,
because those are super crucial for understanding where the price might find support, where it might run into resistance, where it's going to struggle.
okay. Support and resistance. These sound like key concepts. Break those down for me.
Yeah. So think of support as a floor and resistance as a ceiling. Okay?
Yeah.
So support, that's a price level where buying interest is strong enough that it prevents the price from falling further.
Okay.
It's like the safety net.
Okay. Yeah.
So resistance, on the other hand, that's that level where the selling pressure kicks in.
Makes it hard to break through.
Yeah, it makes it tough for that price to break through.
So support's where the price is likely to bounce back up, and resistance is where it might hit a wall and struggle to go higher.
Exactly. And these levels can be based on previous highs and lows, trend lines, even like psychological levels, like round numbers.
Yeah.
People like round numbers.
Oh, interesting. Okay, so once we understand those, we can start to see how certain candlestick patterns might play out near these key levels.
Right.
Okay.
Yeah.
I see where you're going with this. Okay, so how do we connect those levels to those candlestick patterns that we're trying to decipher?
Okay, so let's imagine, right, you see a long green candlestick forming, but it's near a previous resistance level that's held strong for a while.
Okay.
It's been tested a couple times. It hasn't broken through. So now the price is pushing up against that ceiling. We see this strong, bullish candlestick. What does that tell us?
Well, it could be a sign that the buyers are finally strong enough to break through.
Right. But we need more information to confirm that.
Oh.
And that's where volume comes in. It's like the fuel that drives that price movement.
Okay, volume. We touched on that a little bit earlier. Remind me how that fits into this whole picture.
Yeah, so you'll usually see those volume bars displayed below the candlestick chart. Each bar represents the number of shares or contracts that were traded during that specific period.
Got it. So the taller the volume bar, the more active the trading was during that period.
Exactly. And here's the key takeaway. Increasing volume often confirms the strength of a move. So if we see that long green candlestick near resistance and the volume is increasing,
Oh, okay.
that's a stronger signal. The buyers are really in control and the price is more likely to break through.
Oh, got it. It's like having more evidence to support what those candlesticks are suggesting. It's not just about the price movement, but it's about the conviction behind it.
Right, exactly.
Okay, now let's talk about some specific candlestick patterns. Where do we even begin?
All right, well, how about we start with a pattern that screams potential reversal? Let's talk about the engulfing pattern.
The engulfing pattern.
Yeah, imagine a small candlestick, maybe it's red, suggesting some indecision or weakness.
Oh.
And then the next candlestick, it's a long one, but it's the opposite color, in this case green.
Oh, okay.
And it completely engulfs the previous candle.
I'm picturing it. It's like that one candlestick just swallowed the previous one whole.
That's a great way to visualize it. Yeah. And what this pattern tells us is that the balance of power has shifted.
Mm.
In our example, the long green engulfing candlestick suggests that buyers have stepped in with a lot of conviction.
Okay.
They have overpowered those sellers.
So it's a potential signal of a reversal from bearish to bullish.
Exactly.
Yeah.
But remember, we always look for confirmation.
Right. More evidence.
We want to see increasing volume on that engulfing candle.
Okay.
And ideally, the next few candles are continuing that new trend.
So we're gathering clues like detectives,
Yeah,
We're looking for multiple signals to confirm what we're seeing.
that's right.
I like that approach. Okay, so now let's talk about risk management. How do we protect ourselves if a trade doesn't go as planned?
Yeah, that's where those stop-loss orders come in.
Oh, okay.
So a stop-loss order, that's essentially an instruction to automatically sell your position if the price drops to a certain level.
So it's like a safety net, right? Like to limit our losses if things go south.
Yeah.
How do we determine where to place our stop loss when trading an engulfing pattern?
Okay, so if you're going long, meaning you're buying based on that bullish engulfing pattern, you would typically place your stop-loss order just below the low of the engulfing candle. You're basically saying, okay, if the price falls below this point, I'm out. I'm limiting my losses.
Right, I'm protecting myself.
Exactly. Risk management, Super important trading. You always want to protect your capital so you can live to trade another day.
I like that. Live to trade another day.
Right.
All right, we have covered a lot of ground already. We've explored those basics of candlestick charts, talked about support and resistance, and even analyzed our first pattern, that engulfing pattern.
That's right.
What other patterns should we have on our radar?
Let's move on to a pattern that signals indecision and potential reversal. Let's talk about the doji.
Doji. Okay, that one sounds intriguing. Tell me more about this mysterious pattern.
The doji, it's a unique candlestick where the opening and closing prices are almost identical, creating this cross-like shape on the chart.
Okay.
It's like the market's pausing,
Yep.
taking a breath,
Yeah.
unsure which direction to go next.
Oh, interesting.
Yeah.
So it's like those buyers and sellers, they're kind of in a standoff, right?
Yeah.
Neither side has the advantage. So does this mean a doji is always a sign of a reversal?
Not necessarily. It's more like, a yellow light,
Okay.
caution sign. Pay attention. Look for more clues, right?
Yeah.
Because candlestick patterns, they're just one piece of the puzzle.
Right.
We want to look at other things like support and resistance, volume, and, the overall market trends. What's happening?
Okay, so doji's kind of like it's a warning sign, something might be brewing.
Yeah.
We need more information to confirm which way it's going to swing.
Exactly. And you know what? There are actually different types of dojis, each with its own, characteristics and implications.
So it's not just one generic doji pattern, there's variations.
Right. Yeah. And one specific type of doji that's really important for swing traders is the Harami cross.
The Harami cross.
Yeah. So picture this. You get a series of bullish candles.
Okay,
Prices are trending upwards.
he's looking good.
And then, bam, a doji appears.
Uh-oh. That sounds like a potential shift in momentum.
Right.
Like the bulls are starting to lose their steam a little bit.
Exactly. So the Harami cross, that can be a signal of a potential reversal from bullish to bearish.
Oh, okay.
But again, we need confirmation. Right?
Always look for confirmation.
We want to see, strong volume leading up to the doji.
Okay.
So that means, strong conviction in that upward trend.
Right.
But then a significant drop in volume on the doji itself, suggesting that, okay, maybe those buyers are starting to pull back a little bit.
So the enthusiasm is fading and the market's taking a pause. What are we going to do next?
Yeah.
Okay. So what other types of dojis should we be aware of?
There's two other important ones, the gravestone doji and the dragonfly doji.
Okay.
Both have small bodies and one long wick,
Okay.
but their implications quite different.
Right. So I'm picturing those in my mind. Walk me through the differences, and what they tell us about the market.
Okay, so the gravestone doji, as the name suggests, has a long upper wick,
Okay.
and it's usually found at the top of an uptrend.
Gotcha.
So it's like the price tried to push higher, but got met with strong selling pressure.
Oh.
Right. So it gets pushed back down, closes near the opening price.
But the market's reaching for that new high, but gets rejected.
Yeah.
Leaves behind this gravestone.
Yeah. It's like a warning sign.
Be careful.
Yeah.
Okay, so what about the dragonfly doji?
So the dragonfly doji, that one has a long lower wick, and it's typically found at the bottom of a downtrend.
Okay.
So it suggests that the seller's trying to push the price lower,
Right.
but they were met with strong buying interest.
Oh.
So pushed it back up to close near that opening price.
So it's the opposite of that gravestone.
Yeah.
It tries to make a new low, but it gets rejected.
Exactly.
Does this mean the dragonfly doji is always a bullish signal then?
Not always,
Yeah.
but it's often seen as a sign of a potential reversal from bearish to bullish.
Okay.
Again, we want to look for confirmation, from other indicators, increasing volume, and always consider that overall market context. What's happening in the bigger picture?
Context is key.
Yeah,
We can't just blindly rely on these patterns,
right.
We have to see what else is going on.
Yeah, absolutely. Now let's talk about another important concept that can create some unique trading opportunities.
Okay.
Gaps.
Gaps. Those jumps in price that sometimes happen like overnight
Yeah.
or between trading sessions.
Yeah.
I've always wondered what causes those.
So they often occur because of news or events
Okay.
that happened outside of regular trading hours.
Right, when the market's closed.
Right. Earnings announcements, economic reports, geopolitical developments, things like that. Something happens, it shifts market sentiment. And then when the market opens, boom,
It's got to catch up.
it reflects that shift with a gap up or down.
So the market is like catching up to the news?
Yeah.
The price is adjusting to this new information?
Right.
Are gaps something that we can trade?
They can be tricky,
Okay.
but yes,
Oh, okay.
there are strategies for trading gaps. The key is to understand the different types of gaps
Okay.
and what they might tell us about, what the price is going to do next.
Okay, let's break down those different types of gaps. What should we be looking for?
Okay, so we have three main types.
Okay.
Gap and go,
Okay.
gap and consolidation,
Gotcha.
and gap and fill.
Okay, so a gap and go sounds pretty self-explanatory, right?
Yeah.
The price gaps, either up or down, and then it just keeps going in that direction.
That's right. Imagine a stock gaps up on positive news, and then the buying pressure continues, pushing the price even higher.
Oh, wow.
So that's a gap and go scenario.
So it's like a sudden burst of momentum that carries the price even further?
Yeah.
What about gap and consolidation?
Okay, so in that case, the price gaps up or down, but then it starts to move sideways in a range, consolidating those gains or losses.
So it's taking a breather?
Yeah.
Like, okay, let's just kind of chill out here for a minute.
Yeah, it's digesting that news or event that caused that gap.
So it's more of a wait-and-see approach.
Yeah.
We don't know for sure if it's going to keep going or if it's going to reverse.
Exactly. It could break out in either direction.
Okay.
It might continue in the direction of the gap, or it might reverse and fill the gap.
And a gap and fill, that's when it moves back to fill that space that was created by the gap.
Exactly. So traders who bought on the gap might start taking profits.
Oh, okay.
Or new sellers might enter the market, pushing the price back down to close that gap.
So that initial excitement fades and it's like, okay, we're back to where we were before. All right, now how do we actually trade these gaps? Like, what are some practical strategies?
Okay, so here's a simple strategy for trading a gap and go.
Okay.
Consider buying towards the end of the day on a gap up, but only if the bullish trend seems to be continuing.
So we're waiting to see if the gap has legs, if that upward momentum is sustained?
Exactly. You want to see confirmation that those buyers are still in control. And remember, always set that stop-loss order
Right.
to limit that risk in case the trade doesn't go as planned.
Always protect ourselves. Okay, now you mentioned earlier that gaps can create new levels of support or resistance.
Right.
Explain how that works.
Okay, so imagine a stock gaps up
Yeah.
and then consolidates for a little bit.
Okay.
So that gap area might now act as a new support level.
Oh, interesting.
So if the price pulls back to that level, buyers might step in, seeing it as a good opportunity to buy.
So that gap essentially creates this new psychological level.
Yeah.
Where traders might react. Oh, that's fascinating.
Right. Gaps can really change the landscape of a chart.
Yeah.
So pay attention to them and how they might influence that future price action.
Okay, so gaps can provide unique trading opportunities, but they also require careful analysis and risk management. We've covered a lot of ground today, from basic candlestick anatomy to those specific patterns and even those intriguing gaps. What are some key takeaways our listeners should keep in mind as they start to apply this knowledge to their own trading?
I think the biggest takeaway is that candlestick charts, they're not just random shapes. They're telling us a story. They're reflecting the psychology of the market.
Yeah.
That battle between buyers and sellers.
It's like a visual language.
Exactly. By understanding this language, you can gain valuable insights into, market sentiment
Okay.
and potential price movements.
Just like being able to read the mind of the market. You see the fear, the greed, the indecision, the conviction.
Exactly. And remember, it's all about finding that confluence, right?
Yeah.
We don't want to rely on just one candlestick pattern in isolation.
Right.
We look for confirmation from other indicators like volume, support and resistance levels, overall market trends.
So it's like piecing together a puzzle, gathering clues from all these different sources to get a clearer picture of what's happening.
Yeah.
Now, I know we've focused specifically on candlestick patterns today, but there's a whole world of technical analysis out there, right?
Oh, yeah.
What would you suggest our listeners explore next as they continue their trading journey?
Yeah. So candlestick patterns, they're just one tool in the technical analyst's toolbox.
Right?
I would encourage listeners to explore other technical indicators like moving averages,
Oh, yeah.
MBD, RSI, Bollinger Bands.
Okay.
These indicators, they can provide additional insights into momentum, trend strength, and those overbought or oversold conditions.
So it's all about building like a comprehensive understanding of different technical tools
Yeah.
and how they can work together to give us a more complete picture of the market.
Exactly. And remember, trading is a continuous learning process. The more you study, the more you practice, the more you refine those skills, the better equipped you'll be to navigate the complexities in the market.
Absolutely. Well said. It's all about embracing that journey and constantly seeking to improve our understanding
Yeah.
of this fascinating world of trading. Now, as we wrap up this deep dive into candlestick charts, I want to leave our listeners with a final thought-provoking question to ponder. So now that you have gotten a taste of these candlestick patterns, how would you apply this new knowledge to a stock or an asset that you're interested in? Would you jump right in based on just one single pattern, or are you starting to think a little bit more like a detective?
Right.
Gather that evidence, look for confirming signals before you make that move.
That's a great question to consider. It's really easy to get excited about a single pattern.
Yeah.
But remember, responsible trading, it's all about calculated risks and careful analysis.
It's not about emotions, it's about the logic. It's like we said earlier, we're not just chasing those patterns, we're looking for those aha moments, right?
Right.
Where those multiple indicators, they align and they paint a clear picture for us of where that price might be headed.
Exactly. For example, let's say you're watching a stock that's been in a downtrend for a while.
Okay.
You see a dragonfly doji forming near a strong support level.
Okay, so we have a potential reversal signal with that dragonfly doji, and it's happening at a point where the price has historically found support. That's starting to look interesting.
Right. But we're not stopping there. We check the volume, and we see that it's been increasing on the days leading up to that doji.
Okay.
Suggesting that, okay, maybe buyers are starting to step in.
More evidence.
Right.
And then to really seal the deal, we might look for a bullish engulfing pattern forming right after that dragonfly doji.
Right.
Like, okay, now the buyers are really taking control.
Now you're thinking like a swing trader.
I'm getting it.
You're not just relying on one signal. You're looking for those multiple confirmations to increase your odds of success.
Right. Stack those odds in our favor.
Exactly.
And of course, even with all those confirmations, we'd still set a stop loss order just below that support level,
Right.
just to manage our risk in case that reversal doesn't play out as we expected.
Absolutely. Risk management is non-negotiable.
Yeah.
It's how we protect our capital.
Yeah.
Stay in the game for the long haul.
I love that. This whole deep dive into candlestick charts has been incredibly eye-opening. It's amazing how much information is packed into those seemingly simple candlesticks.
It's like a whole new language.
It is.
And the more fluent we become in this language, the better we can understand those conversations that are happening in the market.
Exactly. It's about connecting the dots, seeing that bigger picture,
Yeah.
and making informed decisions based on evidence and analysis,
Yeah.
not just emotions
Right.
or guesswork.
I couldn't have said it better myself.
Awesome.
Trading is a journey, not a destination. There's always more to learn, more to explore, more to refine.
Oh, yeah.
Embrace the process, stay curious, and never stop seeking knowledge.
Until next time, happy trading.
Happy trading.
Thanks for tuning in to Sam's Summaries. If you found this episode useful, let us know with a like, follow, and share. Also, if you haven't already, be sure to visit samfury.com to get free access to all of Sam's original summaries. You can also get any of Sam's books and other exclusive content. It's all completely free at samfury.com.